I'm breaking down the top 3 business valuation methods that every business owner needs to know to understand the value of their business at any time in any market. My team and I have done over $50 million in closed transactions, and I've helped dozens of business owners maximize the value of their business. Now, stick around till later in the video to find out why the third valuation method is usually the one that keeps people from being successful. So we're dealing with a really big issue, which is that 70 to 80% of business owners actually fail to sell their business due to an improper valuation, meaning they don't actually understand the value of their business. Now, the issue with this is that they could sell for way less than the business is worth. And if you understand what the top 3 valuation methods are for your business, then you can actually negotiate better and actually avoid surprises in your sale. Meaning you don't get surprised by a different valuation than you expected. You actually understand what you need to know going into this. You can negotiate the best possible way and get the best possible price, or know the best possible time to sell your business. So method 1 that we're going to talk about is the earnings-based type of valuation. So this is usually done off of a multiple of the EBITDA of the business, or simply just the net profit might be what you're used to calling it. But net profit, EBITDA, kind of the same type of thing. This is basically what the business is profiting every year that you as the business owner are able to take home. And that's the really key thing here. The issue is that most business owners focus on the revenue of their business, and this is the first thing that they think of. They'll tell me, oh, like my business has done $7 million in revenue this year, and that's how I should be valuing it. And the thing is that buyers of businesses really only care about the bottom line profit. They don't really care too much about the revenue. Now, they want to see that you're having good profit margins, but at the end of the day, they don't care that much about what the revenue of the business is doing compared to how much profit it's giving. When you focus on these gross sales, you could end up having some kind of negotiation that falls through, or again, having those unmet expectations that lead to the deal falling through. That's where those 70 to 80% of business owners just don't get the whole thing across the line. They're not able to close the transaction. An example recently is we had a physician that came to us that wanted to sell their practice. And they were doing pretty well. They were doing about $2 million a year over, the sales, but the business was actually only profiting about $100,000. So this person had completely out of line expectations. They thought that they could sell their business for about the same as what it's doing in revenue every year. But the reality is they have so many costs. They have labor, they have rent, they have all these different costs, materials costs, all these different costs that eat out of that revenue. So you as the business owner are not actually taking that home. Now, this person's expectations were so out of line that they thought, oh, like you're going to make your money back in a year if you buy it for only 1 times what the revenue is, but someone would never actually buy it. So we actually had to turn this person away because their expectations were so out of line. We would never be able to actually get them the results that they were looking for. And we understood that because of this. Now, if this person was willing to kind of see it the other way, it would be a different story. We would have done a valuation of their business, and we would have ultimately found that it was worth probably more like $100,000 or $200,000 because that's what the profit was. A tip here is that if you value your business off of a multiple of the net profit and the EBITDA and not revenue, you will give a much more accurate representation of what a buyer is actually going to take home. Now, there is a little intricacy here. A common mistake that people make is that they don't actually represent that net profit or that EBITDA the correct way, and they miss out on showing the full value of their business. I've actually seen it so drastically different before that someone would be losing major value if they did not figure out how to adjust this correctly. And towards the end of this video, I'm going to give you a really good tip and a resource you can use to actually make sure that you're showing this the correct way, which your accountant is probably not usually going to do. Now, this can result in hundreds of thousands or even millions of dollars in lost value when you go to sell your business. And I'll give you an example. There was a business that we were going to sell recently, and actually the difference between what net profit they were showing for tax purposes and what they were actually able to take home was a few $1 million. And this wouldn't only be a few $1 million extra in the sale price of the business, but it would actually be multiple of that. It might be like 3, 4, 5 times that. So this could literally be worth tens of millions of dollars simply just making these correct adjustments. Method number 2 is the asset-based approach. The asset-based approach to valuation is simply accounting for the assets of the business that are within it. Businesses with lots of physical assets, we see often leave out a lot of the actual value that they have within them, or they have over realistic expectations if some of the assets are directly tied to their ability to make revenue. So an example of this is actually recently we were going to sell a trucking company and they got a valuation done, and they actually ended up being worth a good bit less than they had expected, just because so much of their revenue was tied to the trucks that they had, and they didn't own many trucks. Some were rented, some were owned, but they didn't really own that many of trucks. A lot of them were actually owned by the drivers of the trucks. So because they didn't own these physical assets that were so responsible for the actual revenue generation, the business was worth a lot less than they expected. There was also one I looked at recently where they did private jet chartering, but they didn't own any of the jets that they were chartering. They were doing a revenue share with the people that own the jets, which is a great business model, is a great way to get started, but they're worth way less because they don't own those assets that are directly contributing to the revenue. So you might have really unrealistic expectations if you have a business like this. And it's important to understand where you actually stand so that you don't go trying to sell your business and get lowball offers, or maybe get into due diligence and your buyer end up having to lower the price dramatically when you're already bought in and making plans for what you're going to do with the proceeds of your business. Now, this might be ideal though for companies that have things like valuable patents or some kind of intellectual property. That is assuming that the patents or intellectual property, like other assets, are actually contributing to a lot of the cash flow and the revenue of this business. That's the key. If they're just new patents, new intellectual property, and they're not actually creating revenue and creating cash flow, then they could be worth something, but at the end of the day, someone's probably not going to be that willing to buy them yet or to pay a lot of money for them. But if you have patents or intellectual property that is actually producing a lot of revenue and cash flow, that gives you a little bit of a moat around your business, and that could make it worth more. So it's impossible to do an asset-based approach just in addition to anything else that you'd be doing to show the full value of that, capture that full value. Now, it's also important to take inventory of every asset that you own in your business so that you're not leaving out value like this, so that you're actually keeping track of everything that you own. Because if you're representing your business without the inventory, without the assets, you could again be losing hundreds of thousands or even millions of dollars. And we've seen it done before. This is why we like to really hone in on this and make sure to show all of this. You can actually work with a professional appraiser of businesses to get the most accurate value of your business using multiple approaches. So the sponsor of today's video is Out of the Box Consulting, and they actually do professional valuations that are CPA certified. CPA on staff does very comprehensive valuations where it actually uses all three methods that are talked about in this video today. So if you use the code in the link of the description, you can actually get a discount on those valuations today using the special code in the link in the description. So if you are looking to get a valuation with all three of these approaches, go into the link in the description. Now, method 3 is the market-based approach. And I told you earlier in the video that this is actually the one that is the most important and that you would want to stick around for, because this is the one that we often put the most weight into. A common mistake here is that business owners will not actually benchmark their business against comparable or similar businesses in the market that have already sold. And if you think about it, this is kind of like when you go to sell a house, right? If you're going to sell your house and you're getting it appraised, one of the biggest things that they'll look for is what are some of the houses around your house that have sold recently that are maybe similar to your house, or maybe have some comparable qualities. If your house is on a lake or a river or something, they might look for other houses that have sold a few doors down that are also on a lake so that they can give a comparable value. Because if you think about it, the market has already voted with their dollars and said, we will pay this much for that property or for that asset. Businesses are really similar. Now, it's a lot harder to find this kind of data, and usually it's behind different government databases or paywalls or things like that. But if you work with a professional appraiser, often they're able to pull that data for you and be able to show actual companies in your industry that have sold in recent years and how much revenue they were doing, how many employees they had, how much profit they were doing, and what kind of multiple they sold for and in what area, so that you can get a really good representation of what someone might actually be willing to pay. And if you have a buyer that you're negotiating with, you could say, hey, look, this very similar similar company to mine sold for this amount to this person or to this company or something like that. You have some actual precedent for the transaction. Now, an example is that we were working on selling a business that was an industrial company that they thought they were worth about 2.5 times their profit. But when their valuation got completed, they actually realized that they were very niche and there wasn't a ton of competitors selling in this area. And this was actually a really good thing for them because they were niche. There was some comparable data, but not a whole lot. We actually realized that they were worth a lot higher than they were actually thinking that they were worth. Like I said, they thought they were worth about 2.5 times the profit, but they ended up selling for way higher. They ended up getting a valuation. They ended up getting an offer that was actually way above their valuation because there was other companies, other precedent transactions. So they ended up getting an offer for around 5 times the profit instead, which was around double what they thought they were going to get. Now, what happens here is you're using data from actual sales, and this shows you again what buyers are actually willing to pay because they have already paid that much. They've literally already completed transactions with that much. So you can say, hey, this actually happened. This isn't just theory. This isn't just hypotheticals. This is what this business could actually sell for. And that's really the key. And so we usually put the most weight into the market-based approach because it is the thing that represents the value more than anything. At the end of the day, a business is only worth whatever someone's willing to pay for it. And if you get a valuation, that is not the end all be all. Just because you get a valuation doesn't mean someone's going to pay that amount for it, but it can give you way higher leverage, going from where you are now to where you would actually like to be and actually give you a little bit of a roadmap of where you need to be and where your negotiations should fall and what you say yes to, what you say no to when you get offers for your business. So a tip is that you should get some of this market data to be able to look at so that you can at least understand whether your expectations for your valuation are way off. Maybe they're way too high, or maybe they're even too low. Maybe you're going to get more for this business than you thought. Maybe it's actually a really good time to sell, even better time to sell than you thought it would be. Like I said, this is the most important and influential factor in valuations. We usually put the most weight into this one because this is what buyers have voted with their dollars for. But a pro tip is that if you combine all 3 methods of valuation, then you're not just showing one approach and one opinion. It's kind of like if you have a whole council of opinions and of like minds that are actually showing what they think the business is worth, all combined together. And this ultimately gives you the most accurate and the most defensible position to come from when you're going into your negotiations. And that's the key thing that I want to drive home here is you want to come from the strongest negotiating power possible when you're going to sell your business. You don't want to let the buyer do your valuation for you. You don't want to guess. You don't want to take your time with this. You want something that's actually going to give you real negotiating power in your sale. And otherwise, like I said, the buyer could name the price for you. And we've seen this before. We've had people come to us where they had a deal that fell through before because a buyer came to them kind of promising the world, and then they did a valuation on their own, and they ended up not getting the money that they were expecting as an offer, so they didn't go through with the sale. Or even worse, people who have gone through with the sale and they sold for way less, and they ended up getting a lot of seller's remorse afterwards because they sold for less than what they expected to because of how things played out. So my question to leave you with at the end of this video that I really want to sink in is, do you think that someone wanting to buy a business would want to pay more or less for your business? Do you think if you gave them one valuation that maybe didn't show the full value of your business, do you think that they would take that at face value and pay less for it if they were able to? I would say probably so. They're probably trying to get the best discount that they can, just like if you're going to the supermarket, you're hoping to get the best price for your chicken or for your rice, for other groceries that you can possibly get. It's going to be the same thing when someone buys your business. They don't want to pay full price for your business. They would love to get a discount. So don't give them that opportunity, especially if they really want it. You need to have the highest representation of your price possible. This is your most valuable asset in most cases. So I mentioned before, often much of the value is lost in not representing the net profit or the EBITDA of the business properly and not showing the full captured value. So we have an add back template that you can use to actually add back in the things that you need to, that are expenses in your business that are not things that a future owner of the business would actually have to pay for, but that you're representing for tax purposes. Now, like I said, we've seen this literally add millions or even over $10 million of value back into a business, and this is completely free. So you can download this right at the link in the description below. Make sure you show the full value of your business and you can capture that. And if you're serious about actually maximizing the sale of your business, watch this next video about how to do it in 10 steps.